Stock. This represents ownership in a corporation. When you buy shares of a company's stock, you essentially own a portion of that company. Shareholder. This is an individual or entity that owns shares of stock in a corporation. Shareholders have certain rights, including the right to vote on corporate matters, such as electing the board of directors and approving mergers or acquisitions public company. This is a corporation that has issued securities, typically in the form of stocks, that are available for purchase by the general public on a stock exchange. Bull market, bear market. A bull market is a financial market characterized by rising prices and investor optimism. A bear market, on the other hand, is a financial market characterized by falling prices and investor pessimism. Volatility. This refers to the degree of variation in the price of a financial asset over time. Volume. Volume in financial markets refers to the total number of shares or contracts traded in a given period, typically on a daily basis. Capital. This refers to financial assets or resources that individuals, businesses, or governments use to generate income or wealth. It can include cash, investments, physical assets, and intellectual property. Liquidity. This is the degree to which an asset or security can be quickly bought or sold in the market without significantly affecting its price. Bubble. This refers to a situation in which the price of an asset, such as stocks, real estate, or commodities, becomes significantly inflated beyond its intrinsic value. IPO. This is the process by which a private company offers its shares to the public for the first time, thereby becoming a public company. Stock exchange. This is a marketplace where securities such as stocks, bonds, and derivatives are bought and sold. Blue chip stocks. These are shares of well-established, financially stable, and reputable companies with a long history of reliable performance. Forex. Forex, or foreign exchange, refers to the global decentralized market for trading currencies. Portfolio. It refers to a collection of financial assets, such as stocks, bonds, mutual funds, and other investments, held by an individual or entity. Holdings. This refers to the securities or assets held within an investment portfolio. They can include stocks, bonds, mutual funds, exchange-traded funds, real estate, commodities, and cash equivalents. Interests. These generally refer to the fees or returns earned on investments or loans. Bond. This is a debt security issued by governments, municipalities, corporations, or other entities to raise capital. Dividends. These are payments made by corporations to their shareholders as a distribution of profits. Security. This refers to a tradable financial asset, such as stocks, bonds, options, or derivatives that hold some monetary value. Broker. A financial intermediary or agent who facilitates the buying and selling of securities or other financial instruments on behalf of clients. Going long. It refers to the process of buying a financial asset with the expectation that its price will rise over time. Asset. This is any resource or economic resource owned or controlled by an individual, corporation, or government that has monetary value and can be converted into cash. Commodity. This is a raw material or primary agricultural product that can be bought and sold, such as gold, oil, wheat, or natural gas. Yield. This refers to the return on investment generated by a financial asset over a specific period, usually expressed as a percentage of the asset's price or face value. P/E ratio. The price-earnings ratio, or P/E ratio, is a valuation metric used to evaluate the relative value of a company's stock by comparing its current market price per share to its earnings per share. Index. A statistical measure used to track the performance of a group of securities or financial assets within a specific market or sector. Futures. These are standardized financial contracts that obligate the buyer to purchase and the seller to sell a specified asset at a predetermined price on a future date. ETFs. Exchange-traded funds are investment funds that trade on stock exchanges and hold assets such as stocks, bonds, commodities, or a combination of assets. IRAs, an individual retirement account, is a tax-advantaged investment account designed to help individuals save for retirement. Liability. This is a financial obligation or debt owed by an individual, corporation, or other entity to another party. Penny stocks. These are low-price stocks typically trading at less than $5 per share, often with small market capitalizations and limited liquidity. Market cap. Market capitalization refers to the total value of a company's outstanding shares of stock, calculated by multiplying the current market price per share by the total number of shares outstanding. Leverage. This refers to the use of borrowed funds or financial instruments to increase the potential return on investment or exposure to a particular asset or market. Balance sheet. A financial statement that provides a snapshot of a company's financial position at a specific point in time. Inflation. This is the rate at which the general level of prices for goods and services rises over time, leading to a decrease in the purchasing power of money. Options. These are financial derivatives that give the holder the right, but not the obligation, to buy or sell a specified asset at a predetermined price within a specified period. Bid-ask. In financial markets, the bid price is the highest price that a buyer is willing to pay for a security, while the ask price is the lowest price at which a seller is willing to sell. Bid-ask spread. This is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept for a security. Black swan. It refers to an unpredictable and highly improbable event that has a significant impact on financial markets and is typically characterized by extreme volatility and widespread uncertainty. Dead cat bounce. A temporary and short-lived recovery in the price of a declining asset or market after a significant downtrend, followed by a continuation of the downward trend. Whales. In financial markets, whales refer to large institutional investors or high net worth individuals who possess substantial capital and influence, allowing them to exert significant impact on market prices and trading activity. Unicorns. In the financial and investment realm, unicorns refer to privately held startup companies with a valuation of $1 billion or more. To the moon. This is a slang term used in investment communities, particularly in online forums and social media, to express bullish sentiment or exaggerated optimism about the future price potential of a particular asset or investment. Tanking. This refers to a sharp and significant decline in the price of a financial asset, such as stocks, bonds, or cryptocurrencies. Jigged out. This is a term that may be used in trading or investment contexts to describe a situation where an investor's position is liquidated or closed out due to adverse price movements or margin calls. Pump and dump. A fraudulent scheme used to artificially inflate the price of a security by spreading false or misleading information. Rug pull. This refers to a deceptive and unethical tactic employed in the cryptocurrency space. Panic selling. It occurs when investors react to adverse market conditions, negative news, or heightened uncertainty by selling off their investments in a rapid and indiscriminate manner, often leading to a sharp and steep decline in asset prices. Shorting. Shorting, or short selling, is a trading strategy used by investors to profit from the decline in the price of a security. Short squeeze. This occurs when there is a rapid and sharp increase in the price of a security that has been heavily shorted. Limit order. A type of order placed by an investor to buy or sell a security at a specified price or better. Stop loss order. A type of order placed by an investor to sell a security once it reaches a predetermined price level, known as the stop price. Long squeeze. It occurs when there is a rapid and sharp decline in the price of a security that is heavily owned by long investors, causing them to sell their positions to limit losses or meet margin calls. Market order. This is a type of order placed by an investor to buy or sell a security at the current market price. Good till cancelled order. This is a type of order placed by an investor to buy or sell a security at a specified price that remains active until either executed or cancelled by the investor. Day order. A type of order placed by an investor to buy or sell a security that is only valid for the current trading day. Averaging down. An investment strategy where an investor purchases additional shares of a security at a lower price than the original purchase price, thereby reducing the average cost per share of the investment. Fading. A trading strategy that involves taking a contrarian position relative to the prevailing trend in the market. Hedge fund. An investment fund that pools capital from accredited investors or institutional investors and employs a variety of investment strategies to generate returns. Mutual fund, an investment vehicle that pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. Control stock. It refers to shares of a company's stock that are owned by insiders, major shareholders, or other individuals or entities. Holding company. A type of corporation that owns controlling interests in other companies, typically through the ownership of shares of stock. Index fund. A type of mutual fund or exchange-traded fund, ETF, that seeks to track the performance of a specific stock market index, such as the S&P 500 or the Dow Jones Industrial Average. Day trading. This is a trading strategy that involves buying and selling financial assets, such as stocks, options, or currencies, within the same trading day. Swing trading. A trading strategy that involves holding positions in financial assets, such as stocks or options, for several days to weeks, with the goal of capturing short to medium-term price swings or trends. Intrinsic value. This is the perceived or estimated inherent worth of a financial asset, independent of its market price. Book value, also known as shareholders' equity or net asset value, represents the total value of a company's assets minus its liabilities. Price-to-book ratio. This compares a company's market value per share to its book value per share. It's calculated by dividing the current market price of the stock by its book value per share. Value investing. An investment strategy that involves buying stocks or other assets that are considered undervalued by the market, with the expectation that their prices will eventually rise to reflect their intrinsic value. Growth investing. An investment strategy that focuses on buying stocks or other assets of companies that exhibit strong growth potential in terms of earnings, revenues, and market share. Earnings per share. A financial metric that represents the portion of a company's profit allocated to each outstanding share of common stock. Technical analysis. A method of evaluating securities by analyzing statistical trends and historical price and volume data, typically using charts and technical indicators. Fundamental analysis. A method of evaluating securities by analyzing a company's financial statements, business operations, industry trends, and macroeconomic factors to determine its intrinsic value and investment potential. Efficient market hypothesis. This is a theory in finance that posits that financial markets are efficient and reflect all available information. Supply and demand. A fundamental economic principle that describes the relationship between the availability of a good or service and the desire or need for that good or service in the market. Insider trading. This refers to the buying or selling of a publicly traded company's stock by individuals who have access to non-public, material information about the company. Ticker symbol, a unique combination of letters and/or numbers used to identify a particular publicly traded company's stock or security on a stock exchange. Compound interest, the process by which interest is earned on both the initial principal and the accumulated interest of an investment over time. Profit margin, a financial ratio that measures a company's profitability by expressing its net income as a percentage of its total revenue. Dollar cost averaging, an investment strategy that involves investing a fixed amount of money at regular intervals into a particular asset or security, regardless of its price fluctuations. Return on investment, a financial metric used to evaluate the profitability or efficiency of an investment relative to its cost. Here's to your success in building wealth and achieving financial freedom. Don't forget to like, subscribe, and share your thoughts in the comments below. Until next time.